So you've probably heard about the FTC foreign tax credit, but don't know exactly how it works. In this video, we're breaking down the foreign tax credit in the USA. This is a video for American citizens, and the FTC can be a powerful tool for US taxpayers with international income to slash their tax bill and avoid double taxation. If you're an expat earning abroad, an investor with foreign dividends or cash flows, or a business owner with global operations, the FTC could save you thousands by crediting foreign taxes paid against your US tax liability. As of September 2025, with inflation adjustments and minor policy tweaks from the recent legislation, like the big beautiful bill. So now the rules are more relevant than ever. By the end of this video, you'll know exactly what the FTC is, who qualifies, how to claim it, key limitations, and we'll give you some real world examples as well to help you maximize your savings. So let's dive in. First off, what exactly is the foreign tax credit? Established under the Internal Revenue Code, it's section 901-909. The FTC lets U.S. citizens, residents, and certain non-residents offset their U.S. tax on foreign source income with taxes already paid to foreign governments. It's designed to prevent double taxation. Paying tax twice on the same income would suck. For instance, if you earned $100K in Germany, you're living in Germany the majority of the year, you got to pay 25, maybe even 50K in German taxes. You can credit that against your US tax bill, potentially wiping out or at least reducing what you owe to Uncle Sam. Unlike a deduction, which only reduces taxable income, the FTC is a dollar for dollar reduction in your tax liability, making it far more valuable for most people. In 2025, with global trade booming, people are living more internationally than ever. Remote work is normalized. The FTC is a must-know for anyone with cross-border finances or any American that wants to be an expat. So why bother with the FTC? The benefits are huge. I would say it's a must. Otherwise, you're paying double taxation. So you kind of have to know this stuff. And it promotes fairness in a global economy where U.S. persons are taxed on worldwide income. Without it, you'd face effective tax rates over 50% on foreign earnings. U.S. rates, which is up to 37% federal plus state, plus foreign ones, which might be, who knows, 45% in France. The FTC caps your total tax at the higher of the two rates. It's flexible. You can choose it over a foreign tax deduction annually, and it pairs well with other expat relief like the Foreign Earned Income Exclusion, the FEIE, which actually rose to 130K in 2025. And we have other videos on the channel about the Foreign Earned Income Exclusion, which I recommend you check out as well if you're living abroad. Plus, this is another huge thing. Unused credits can carry over, turning potential losses into future savings. For investors, it's key for foreign stocks or mutual funds where withholding taxes are common. A lot of countries have withholding taxes of 15 to 30% when you make money in those countries. In 2024, the IRS processed over 5 million FTC claims, averaging 1,200 in credits per filer. Proof of its impact. But we can definitely see this could grow from 5 million to 50 million Americans in the future. Who qualifies for the FTC? Broadly, any U.S. citizen or resident alien taxed on worldwide income can claim it for foreign taxes paid or accrued. This includes expats, digital nomads, and basically anyone with foreign investment. Non-resident aliens qualify only if they're Puerto Rico residents, for example, or if the foreign taxes on income effectively connected to a U.S. trade or business. It gets a bit complicated, kind of an edge case. Estates and trusts can also claim it. Here's a key caveat. You must have paid or accrued the tax yourself. It's not available for taxes withheld on excluded income like FEI amounts. So, let's talk a bit about what foreign taxes qualify. Not all do. The IRS is picky. Qualifying taxes must be legal, compulsory income taxes, or in lieu of them, imposed by a foreign country or a U.S. possession like Puerto Rico. This includes income, profits, excess profits, taxes at national, provincial, or city levels. A couple of examples here would be withholdings on dividends, salaries, royalties, self-assessed income taxes abroad. Some stuff that's non-qualifying would be VAT taxes, sales taxes, unfortunately, property taxes, or penalties. Property taxes, you could maybe figure that out with business income. Social security taxes qualify only if under a U.S. treaty, such as with Canada. So Social Security is kind of on a country-by-country basis. In 2025, the digital economy taxes like France's DST are creditable if they meet the attribution rules, quote unquote. Attribution is an important word there, tied to profit, not sales. Convert foreign taxes to USD using the average exchange rate for the year on an accrual basis or spot rate on payment date on a cash basis. Always keep records, foreign tax returns, receipts, and the Form 1099. So how do you claim the FTC? Start by choosing credit over deduction. It's usually better as it directly cuts your tax. File Form 1116 with your 1040. It's required unless you qualify for certain exemptions. And by the way, MyLatinLife, we're a full-scale tax and immigration consultancy. If you need help with your expat taxes, among other things, there's a link in the description where you can book a call with us. You can be speaking to us right away. If you're looking for an accountant, if you need a visa, if you need to optimize your tax and business structure, we can absolutely help. Book a call, link in the description. Moving on, let's talk limitations. The FTC isn't unlimited. The big one, your credit can't exceed U.S. tax on that foreign income, preventing refunds on excess foreign taxes. Calculate per category to maximize. Mixing high tax passive with low tax general dilutes it. For 2025, adjust for qualified dividends, capital gains, using the line 18 worksheet if they reduce your rate below 37%. There's a high tax kickout if passive income's effective foreign rate is greater than the US rate of 37%. Reclassify as general for better credit. There's these carrybacks, carryovers for 10 years to handle excesses. Use Schedule B for tracking the excesses. So it gets complicated, but in 2025, the One Big Beautiful Bill extended carryover relief for certain 2024 losses per IRS guidance, which is nice. No credit for taxes on excluded FEIE income or housing allowance. Subtract proportional. So choosing credit versus deduction is a pretty interesting topic here regarding the FTC. Credit wins if your foreign rate is less than your US rate, so you get a full offset. In other words, if you pay more in the foreign country than you would have paid in the US, you get a full offset. Deduction, which is Schedule A, suits high foreign rates or if you itemize heavily, reducing AGI for other benefits. Switch within 10 years for credit, 3 years for deduction. There's the SALT cap, there's different use cases, there's overriding codes, there's lump sum pensions, special averaging. Suffice to say, it gets complicated fast. So this is something that you really want a professional accounting firm to handle. I would mention some pitfalls to avoid are mixing categories. You want to file separate 1116s. Another pitfall is underreporting foreign income, which could trigger audits. Another one is currency conversion errors. Make sure to use IRS approved rates. Another one is forgetting carryovers. You want to track that with software like TurboTax if possible. Another one is failing to elect accrual. Cash basis misses timing benefit. Another one is to think about the FEIE and how to combine for zero tax on salary, crediting investments separately. Another pitfall is the penalties. So there are penalties for underpayments or underreported treaty positions. Some tips for success: use software like TurboTax or H&R Block for the computation. Manual errors are common. For me, I think TurboTax is still too manual, and I'd rather just pay somebody. We have really good expat lawyers here at MyLatinLife. So if you need some help, there's a link in the description where you can book a call with us, become our client. Be sure to keep your records for 7+ years. Keep all your foreign returns, all your 1099s, exchange proofs. You really want to consult pros for complex cases. Anything with the guilty tax gets even more complex as well. File extensions if you need to. The extension gives you up to October 15th because often you need to submit the foreign return before you submit the US return. So file the foreign return first and then file the US by October. In summary, the FTC, the foreign tax credit, is your shield against double taxation with 2025 tweaks. In summary, the FTC, the foreign tax credit, is your shield against double taxation. It's accessible yet nuanced. If the expat life calls, you're going to want to get acquainted with the FTC, the foreign tax credit. If you have experience with the FTC that you'd like to share in the comments, we'd love to hear any anecdotes from you guys, any stories that you have. And please like the video, subscribe to the channel for more tax and citizenship guides, and we'll see you in the next video.